Corporate finance practice problem in OneNote. We're going to think about a bond sales, calculating the bond sales price, and then the percent profit or rate of return on a short-term sale of the bond. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're going to be in the icon on the left-hand side. We're in the practice problems down here in the 1018 bond sale percent profit ROI tab. Also note that when using OneNote, you might want to take a look at the immersive reader. Many of our presentations will be mirrored down here in the text file areas with the same number and name text files, in essence having transcripts that can be translated into multiple different languages and then listened to or read in those languages, being then a good complement to the presentations up top. Closing this back out, we're going to have our information up top. We'll then use that information to go through the calculations on down below. Scenario: bonds outstanding, we have the par value 1,000, the percent, the 12%. They mature in 20 years. We're imagining this is the information that basically you can imagine being actually on a bond, getting from the resource, the bond itself, if you actually had a physical bond. The items not on the bond would be, say, the market rate or yield. The present yield we'll have down here, which is going to be the 18%, and then we'll consider it going down to the 14%. So how we want to go through this practice problem is to first think about what we would think of to purchase the bond. What would be the price we would be purchasing at if we consider the 18% to be the market rate and the 12% bonds up top, what would we purchase them at? Imagine that we then do purchase, then at a later point in time or very close in the time frame, still having the maturity date 20 years, short-term sale then, and at the rate has changed now, market rate to 14%. So we then want to calculate what the price would be at the 14% that we would consider selling the bonds at, then consider any gain or loss on the sale and what our rate of return on that gain or loss will be. So let's go through the steps here. First, we're going to consider purchasing the bond. So we're imagining purchasing the bond. We're imagining that we believe that the fair market rate is 18% for similar bonds, and therefore we're going to figure out what type of price we might be willing to pay to buy the bonds at $1,000 bonds at the 12% rate on the bond, and the 20-year bonds, we're going to do the present value of an annuity and the present value of one. We'll do this a bit more quickly because we've kind of seen these in the past, but we still want to run through these scenarios to think about what the price is made up of. So we're going to say the annuity portion is going to be P, which is going to be the 1,000 times the 12% on the bond, times 1 minus 1 plus R. R is then going to be the market rate at the 18% for the purchase price, to the negative N, which is going to be the number of periods, in this case 20, divided by R, once again the market rate at the 18. Putting that into our formula down below, we're going to say the 120 outside, that's going to be the 1,000 times the 12%, working then on the numerator, bringing the 1 to the inside, and then this 1 plus R to the negative N. 1 plus R, 18%, that being the market rate now that we're purchasing at or considering the purchase. 1 plus the 18%, or 1 plus 0.18 or 100% plus 18% gives us 118% or 1.18. Then we're going to take that to the power of 20. I won't pull out the financial calculator to do this, but just remember that you need a calculator that you can take to the power of negative 20 with. Practice that if you're not used to doing that on a test, and you expect that you might need to do that on the test. And then we got the 118% to the power of negative 20 gives us 0.036505661. Then the 1 minus the 0.036505663 will give us the 0.96349437. That's the num, or the numerator. Taking that divided by the denom, or the denominator, R, 18%, market rate, 18%. The num divided by the denom is going to give us, that's going to be this 0.963 and so on, divided by the 18. The 5.3527465. And then finally, P times that 5 point so on will give us the price of the annuity, the 642.33. So that's going to be the annuity amount of the price. Now we got to figure the present value of 1, which is going to be the present value of that 1,000, bringing it back to the 20 periods. Also note before we go forward that we can see from this, we can see that the 12% is going to be on the bond is less than the market rate. So that means if we're buying the bond, if we're considering ourselves on the purchasing side of the thing, we're going to say we kind of have an advantage. We're going to say, hey, I'm not going to purchase it at $1,000, the face amount of the bond or the par value, because I can find other bonds which will pay me 18%. But if you lower the price, having the value, you can't change the rate most likely because it's on the bond. You can lower the price. I would purchase it at a lower price. What will that lower price be? That's what we're finding. So we expect then the result to be less than 1,000. We don't know exactly what that result will be. So then if we scroll down, we can do that same calculation. We're going to do the same calculation a few more times before doing the present value of the 1,000. The easy way to do it is with Excel, where we have the present value, and if the rate would be the market rate, we're talking 18%, comma, number of periods, that's going to be the 20, and then the payment, because it is an annuity portion, that would be the 1,000 times the 12, which would give us that 642.33 again. We can do that breaking that present value of an annuity out into 20 present value of 1 calculations. And it's useful just to understand that theoretically, so we'll do that quickly. We have period 1, 120 payment. That's going to be the 1,000 times the 12. If we present value that, I won't do the calculation here. You can imagine doing it in Excel. We do this in Excel if you want to take a look at those present value calculations and how to put a table like this together. But that would be 102, value 102. 2 periods out, the second payment, 120 again, then present value back 2 periods would be 86. 86 plus the 102 gives us the 188. Next one, third payment, 120, present value back 3 periods, 73. That 73 plus the 188 would give us the 261, and so on and so forth until we get all the way down to the 20 payments, bringing us to that 642 again. Doesn't include the pennies, but is the same amount as the 642.33 we got to up top. Then if we wanted to, we could continue this process, adding the present value of that 1,000 principal that would happen after 20 periods, which would be equal to $37, about, no pennies added. We will do this calculation again, showing the calculation in multiple ways shortly. But you can tack that onto the table, getting to the answer to the price without the pennies here of the $679. That price less than the 1,000 face amount of the bond due to the fact that the rate on the bond, 12%, is less than what we're perceiving to be the market rate. This then would be what we would consider paying for this particular bond. That's what we will consider to pay for the bond, and then later we'll sell it when we believe the market rate is at the 14%. So before we get there though, let's do the 642 calculation again. So if we scroll on down, actually no, we'll leave that calculation there. We will move on. We're going to move to the 1,000. Now let's do the present value of the 1,000, present value of 1, the principal portion, formula, PV time or equals. I'm going to say future value over, future value being the 1,000, 1 plus R, R being the market rate, 18% in this case, to the N, that's 20. Breaking that out in our table format, 1,000 in the outer column, 1 plus R to the negative N is going to be 1 R, 18% rate, market rate, in other words. 1 plus the market rate is 118%, taking that to the power of periods. The number of periods, in this case years, 20 of them. So 118% or 1.18 to the power of 20 gives us the 27.393035. Then if we take the num divided by the denom, or the numerator over the denominator, we get 27.393035. I'm sorry, the 1,000 divided by the 27.393035 gives us 36.51. That's going to be the present value of that one payment, the 1,000. If we add that to what we got on the annuity, the 642.33 last calculation, we get to the price again, that's 678.84. That price, what we would expect to pay or be willing to pay for these bonds, less than, of course, the par value of the bond due to the fact that the market rate we're assuming is greater than the rate on the bond. So we're saying, hey, we'll pay for those bonds if you sell them to us for 678.84. And that rate we got to up top too, we got to that here, 679, about same calculation. Now we imagine we purchased the bonds at this 678.84. Next part of the problem, we're saying now time has passed, so time has passed. Not much time, we're saying less than a year, we still have the bond is 20 periods out, but now we see that the present value of the rate has now changed. The market rate is now at 14. Everything else is the same. There's been a change in the market rate. So now we're like, man, we could sell this at this point. What would be the price that we would be willing to sell it at if the market rate goes down? Okay, so that's going to be the next question. However, before we get there, let's calculate this one more time, that 36.51. We can calculate using Excel. That's going to be the present value of the rate, 18%. Number of periods is going to be the 20, comma. Future value is then going to be the 1,000. That would give us, again, that 36.51. So, and then we're not going to do it with the tables. Now we're back to the second part. So now we're at the 14. 14 is the new rate. Nothing else is going to change. And now we're considering selling it at this point in time. What would we be willing to sell our bonds that we purchased at if we think the market rate is 14%? Well, let's do our calculation again. Present value of the annuity, now using the 14%. So P is still the 1,000 times the 12%. 1 minus 1 plus R. R is now 14%. That's the market rate. To the negative N is still 20. So not, we're still 20 years out here. Over R, which is 14%, the new rate again. Let's do that calculation in our table format. 120, same, 1,000 times the 12%. Then we'll do the numerator, 1, and then we got the 1 plus R to the negative N. There's the 1, R, 14%. That's the new rate. That gives us 114%. To the number of periods is still 20. So there's the 20, hasn't changed. So 114% now, or 1.14 to the power of negative 20, gives us 0.072766172. Then 1 minus 0.072766172 gives us 0.927238828. That's the num, or the numerator, divided by the denom, which is now 14% as opposed to the 18%. Denom, 14% as opposed to the 18%. Then the num divided by the denom. Num over the denom, numerator divided by the denominator gives us the 6.62313055. And then we take the 120 times the 6.6323133055 gives us the 794.78. So this is going to be the value of the annuity portion, given our new factor now, 14% market rate. Now we need to consider what the value of the present value of 1 will be to get the price that we're willing to sell at. Before we do, however, let's calculate this again using Excel this time, the easy way. Rate now, new rate, 14%. Number of periods would then be 20 still. That stays the same. We're keeping it the same. Payment then is going to be the 1,000 times the 12%. That gives us that 794.78. The easy way, the magic way, the Excel way. Then we're going to do the present value of the 1,000 calculation. So that's going to be the present value equals the future value. That's going to be the 1,000, same as last time, over 1 plus R. R now 14% as opposed to 18% to the power of the number of periods in 20. That's the same. So difference here, 14% instead of 18% market rate. Future value, the num, 1,000. 1 plus R to the N. There's the 1, there's the R. That's the new thing, 14% as opposed to 18. That adds up to 114 or 1.14 or 114% to the power of 20, caret 20. And then we'll say 114 to the power of 20, caret 20 is 13.743490. Then we take the num divided by the denom, numerator over the denominator, gives us 72.76. If we add that amount to what we got from the annuity calculation, we get to a price of, that the annuity calculation was 794.78 plus the 72.76 gives us the 867.54. That then being the price that we would be considering at this change in the market value. So that's what we would consider selling at this point in time, the 867.54. So then if we then calculate that another way, I'm going to calculate this 72.76 the easy way using Excel first. So now we're going to say that the calculation would be the present value, would be the rate, 14% as opposed to the 18%, that's the market rate. The number of periods would be 20 still, and then comma, and then we have the future value, which would be that 1,000, bringing that 1,000 back to the present at the 72.76 again. So then we can calculate basically our rate of return type of calculation here if we were to sell now. We purchased at the 678.84. That's going to be the purchase price. That was the first calculation that we had in the purchase when we assumed the 18% on the yield. That price was less than, of course, the 1,000 on the par value or face amount due to the fact that the market rate was at the 18 at that point in time. Then the market rate went down. We perceived that it went down. So note that the market rate went from 18 to 14. That's closer to what it would be on the bond, which was 12. So you would think then that we would have to pay a little bit more for it at that point in time. In other words, if you kind of consider this purchase price, when I purchased it, we would be saying if we were at 18%, we would say, hey, look, I can't purchase your bonds at 1,000 because I can buy other bonds and be getting paid 18%. You're only paying me 12%. So I should get, a discount. So I'll get a discount, which is going to be the 678.84 we figured. Then if the market rate goes down to 14%, now it's still a situation where that's higher than the bond rate, but you would think we'd get less of a discount because they're closer in nature, right? We'd still be saying, hey, look, if I was to purchase this, I'd be saying, hey, look, I could still get a bond that pays me 14%, so I'm not going to pay you 1,000, but 14% is closer than the 18%. So you would think there would be less, the price would be, less drastically different, less of a discount than the 1,000. So we purchased them when they were more drastically discounted because the market rate was perceived to be a lot higher than the rate on the bond. And now they're still discounted, you would think, if we figured the price, because the rate that we could get elsewhere is still higher than what's on the bond, but they're less discounted, they're closer. Therefore, if we sell it at this point, you would think that we would sell it at a gain, right? So we got the 867.54, what we sold it at, minus the 678.84, what we purchased at. That's going to be then the gain of the 188.70. And then we can kind of compare that to the purchase price. We purchased them for that 678.84. If we take that 188.7 divided by the 678.84, make it a percent, we get the 27.80%. So we'll pull out the trusty calculator for the final calculation here. So we're selling them for the 867.54 minus the purchase, the 678.84. That means we have this in terms of our gain, that 188.7. If I take that and divide it by what we purchased it for, which is this number, the 678.84, we get, if I make the calculator a bit larger here, the 27.79. If I make that a percent, 27.8 about percent.